All right. Good afternoon, everyone. This is Sanjeev Mota from B&K Securities. Welcome all of you to this another session of Fireside Chat. We have with us today the management team of Home First Finance. We have Mr. Manoj Vishwanathan, the CEO, and Mr. Nutan Gava, the CFO.
Hello.
Welcome both of you to this Fireside Chat. So we also have Sanket Chheda, who's the head of our NBFC sector. So Manoj and Nutan, the way we'll do it is we'll start with, I guess, a presentation from you all for about 10 minutes, just telling us about Home First Finance and the key thoughts in your key strategy. And then we'll ask the Q&A. And I guess we'll just stick, as we discussed, we'll stick to structural issues, company level issues in terms of organizational structure and so on, and long-term thought process and sector. So we'll just do that.
Sure.
So Nutan, over to you for putting up the presentation and then.
Sure.
Yeah. Thank you, Sanjeev. Yeah. So we represent Home First Finance. It's a 10-year-old company, and I think we just jumped into the slide because this is the crux of the whole business. We are in the affordable housing finance space. So providing housing loans to customers who are building or buying their first home. And these are customers from an income background of family income background of between say 20,000 rupees to about 50,000 rupees a month. So that's how this segment and this business is defined. And these are some of the customers, in this segment to whom we have actually provided loans. So what is unique and what is different about this segment is that you get customers from different profiles. Some are salaried, some are self-employed. But what is common across this entire segment is that almost all of these customers do not have completely formal income, in the sense of everything which is available or can be established through documents. So they are all working in small companies. They may be working in small companies, or they may be doing small businesses. They may even be working in larger companies. But they find it difficult to provide all the documentation that is required by the large and formal lenders or large banks for providing a housing loan due to various factors. So it could be as simple as the employer not providing salary slips, or it could be even be as simple as I feel embarrassed to go to my employer to ask for salary slips. So it could be any number of such reasons. Some are self-employed, of course, and they don't have the documentation. They have been running a business, and they might have filed returns. They have misplaced their returns. They are below the income tax return bracket, so they have not filed returns. It could be any number of such reasons. So just going through the examples that are here in front of you. The first example is actually what we call as a formal salaried customer. So where customer is getting some part of his income or her income in their bank account, and ideally this should be a customer for a bank, and the bank should be finding it easy to underwrite these customers and provide them a loan, but they do not, because the customer also has other income. So for example, this customer is a teacher. And so she's getting some income in the bank account from her school, but she's also taking tuitions, and her predominant income is through tuitions. Plus, her husband is working in a small company, and he's also getting, some small income where he's not able to prove the income through salary slips, etc. So while this overall family income is about 50,000 rupees, the income that they can actually show proof for is only about 20,000 rupees. So if they go to a large bank or a formal lender, they will only get a smaller loan amount, which is as per their documented income. And that is not enough or sufficient for them to complete this loan or home purchase transaction. If coming to the second customer, this person is, he's polishing diamonds. This is a large industry in Surat, for example. And most of these customers earn their salaries in cash. Their employers pay them in cash. His wife is also working somewhere, and she's also getting paid in cash. So while they have the ability to repay the loan, and they are getting a monthly income of about 40,000 rupees, and they can easily pay an installment of 10,000 rupees a month, they do not have sufficient documentation to convince the bank or a large lender to provide them a loan. So that's the challenge these customers face. And the last customer is a self-employed customer. He's running his own business. He's getting some of his income in cash. So he's not he's below the income bracket. He's not filing his returns. Again, finds it challenging to get a loan from a large lender. So these are the kind of customers that we deal with, and this is a very large population or very large number of such customers who are looking to build or buy homes. And our estimate of such customers in the country today on an annual basis who are looking to build or buy homes is about 2 million customers. So that's the size of the market on an annual basis. And every year that number is only going up. So that's the size and scale of this business. That's the complexity in this business, and that's the business we are in. So some companies like us, we have developed the expertise to evaluate these customers. You also so you have so there are multiple challenges in this. So you have to first of all evaluate a customer who does not have proper formal documentation for his income. So you have to estimate his correct income. You have to do that with a high level of accuracy, because otherwise you will end up making mistakes, and then the customer. Some of these customers themselves are not, you can say, cognizant of the fact that they may not be able to avail the loan, or they may not be able to afford a loan. So they may get into a wrong transaction. So you need to actually educate them that their income is not sufficient for a loan, etc. So you have to evaluate very accurately, and the post all of this, and you have to do all of this at a low cost, because if you this is not a very high margin business, so you cannot spend a lot of time or a lot of money on the evaluation process. So all of this has to be done at a low cost, and at the same time, post all of this, I mean, after doing all of this evaluation, taking the correct decisions, this is also a segment that is vulnerable, to various fluctuations, and hence you need to be able to handhold them throughout the process, and help them in case they face difficulties afterwards, when they, after the loan is disbursed. So these are the challenges in this business, and what we have brought to the business is basically, the ability to use technology to address some of these challenges, or some of these you can say missing elements which were there in this business. So coming to the origination and evaluation part, we are using technology to do that a little more efficiently. So one of the challenges that the industry always faced in this business was, how do we know the person is actually working there when does not have salary slips, etc. So we have brought in technology from day one to address some of these challenges. So we actually record a video of the person doing that activity or his workplace. We record conversations with the employers. We scan documents. So we don't approach it in a conventional way where the way the housing finance industry works, which is there are very standardized documents. If anybody in this country is asked, what do you have to provide for a loan, or what do you have to provide for a housing loan, everybody knows it, because it is very standardized and it's like general knowledge. So everybody will say, yes, 3 months salary slip, 6 months bank statement, you have to provide your KYC. That's the standardized. That is what has been publicized. But we don't approach it that way. Many of these customers probably don't have salary slips, but they would have their salary registers in which the employer maintains, where he is providing them cash salary every month, and he's getting their signature or thumb impression on the register. We look at what kind of investments the customer is making. So many customers have monthly payments going for their LIC policies. We have we look at the business records of the customer in case he's self-employed. What is he buying, what is he selling on a monthly or daily basis. So it's a very different method of evaluation, and we have and we eliminate the the question comes is that there is a lot of subjectivity. The person who's going and observing all of this is we are dependent on him, etc. So that is what we have tried to eliminate in this business. So whoever is going and observing all of this and discussing with the customer, we have tried to capture everything digitally. So whatever documents, for example, LIC policies, property papers, cash registers, all of this is actually digitally scanned and uploaded on our system, and that takes away a lot of the subjectivity that was there in this business of affordable housing. So even a person sitting centrally in our office can actually experience what the customer is going through, what we are and what we are seeing, where the customer is working, where is he living, etc. So we get a much more, you can say, granular feel of the customer's actual profile, and that is what helps us with underwriting, and that's what helps us to underwrite more accurately. So we have used you can say technology and digital processes in all aspects of the business. If you look at this chart here, so there are basically four pillars. So coming to the lower left-hand side pillar, the acquisition part. So this is something which is more recent, where the customers are getting more comfortable in applying for loans online. So we have our own digital marketing setup here, and we advertise online. We get leads from customers, and then the leads are converted into loans. So this is the digital marketing part. We also have alliances with several players. Some of their logos are there at the bottom of the table. So they also send us leads for housing loans. So this is the first part, which is the acquisition part, where we are using technology. We also have mobile apps for our you can say business partners who send us customer inquiries, so connectors, etc. And they again send us the name and number of the customer on the mobile app. So this is all on the acquisition side. Then coming to the evaluation, which is the top right hand side corner. Again, how we are taking away some of the subjectivity in this business is to validate the data that we are collecting in the field. So we are collecting data through videos and scan of their documents, etc. We are validating that through digital digital databases that are available. So for example, vehicle ownership database is available, GST database, Provident Fund, and so various such databases are available, where we can actually validate what the customer is saying. And some of this is also going to get strengthened with this account aggregator and other such networks coming up. So that is the second part, which we second step of the process, where we validate the data digitally. Then, like I mentioned, all of it is stored on the cloud. It is available to our centralized team of underwriters. So here again, we have tried to remove the subjectivity of a local underwriter and his limited knowledge and skill sets that may be available. So centralized underwriting through a cloud-based application, which is salesforce.com. And then, the last part is, of course, the servicing of the customer. So as I mentioned earlier, all of this needs to be done at low cost. So we have tried to, provide all servicing to the customer at his, fingertips through a mobile app. So anything that the customer requires in the form of statements, his next payment, or even if he wants to make a payment or he wants to make a prepayment, everything can be done on the mobile itself. So this again helps in reducing the cost of the whole operation. So improving the accuracy, improving the speed, reducing the cost, and providing a good experience to the customer. I mean, this is what. So that's a business, and this is how we have used technology in various aspects of the business to achieve that. Just giving you a bit of a snapshot of the business. So in the last 10 years, we have raised capital 4 times from some very good names. So we have True North, the private equity fund as one of our shareholders. We have GIC of Singapore, we have Warburg Pincus, and we have Bessemer Venture Partners, which are all very reputed names in the private equity world. They're all our shareholders. We have built a book of about 4,500 crores in the last 10 years. We have always maintained a fairly good, GNPS. And prior to the pandemic, that number used to be around 1%, and post-pandemic, it is in the region of about 1.8%. And as far as the distribution is concerned, we are present in some of the largest markets in the country, which are the most prosperous markets and the largest affordable housing markets. So largely focused on these west and southern part of the country. So all the states that are contributing or large contributors to the GDP of the country, and affordable housing demand is also directly correlated to the per capita GDP. So this is in a nutshell, the business. So 4,500 crores of AUM across about 55,000 customers. The yield is around 13%, spread around 5% at this point of time, 5.5% at this point of time, and clocking an ROE of about 10 plus percent is where we are. And I think, yeah, that's a quick snapshot of the business.
Sure. Thanks, Manoj, for that. So now we'll come back to the business part and the sector and business part. Maybe just we'll start quickly with the organization itself. So you, as you said, you're a private equity funded business, and now you've become listed. If you can just talk about the journey and how different it is now that you are listed in versus private equity, and what did private equity bring on table that in terms of learnings and so on. That'll be great to hear. Yeah.
See, our company is fairly unique in the sense that it was started by you can say industry ex-bankers. So the founders of the company are Mr. Jerry Rao, Jaykumar, and myself. All of us come from a banking or financial services background. So in that sense, it's a completely de novo startup without any corporate house, so to say, backing the company. So in this journey, private equity firms have played a large role. So right from taking a bet on us in the beginning, and then staying on with us, and then over time, you can say larger private equity firms have joined the share table. And this is ours as a business, and especially housing loans as a business where you require some large amount of capital, to build scale. So in that sense, you can say founders of the company were not hesitant to dilute their shareholding to build that you can say build that shareholding of the private equity firms or build scale. And which is why we are seeing some of the very reputed or well-known names in private equity world who are our shareholders, and they are the predominant shareholders. And True North and GIC are also promoters of the company now. So different you can say private equity firms have played different roles. So in the initial stage, we had Bessemer Venture Partners, who came in when we were basically more of a concept. And so they were able to you can say take a bet on us at that point of time, which once the proof of concept was established, we got Tata Capital as a second investor. They stayed with us and kind of built the backbone of the company. And when True North came in, they exited. When True North came in, they come in with a perspective of taking on a mid-sized company and then building it up into a very scaled-up operation. So which is what they have helped us do. So in 2017, they came in with the investment. They have also been helping us, with various aspects, of running the company on the technology side, liability side, governance, operations. So over the last 4 years, we have got a solid, you can say, support from True North, and we have kind of scaled up to a point where we were able to list the company. Warburg actually joined us last year when we felt that we may require a large shareholder to tide us through COVID. That's when Warburg came in, and they also came in at a time when, frankly, everything was uncertain. So their coming in was also a huge endorsement of the company's, you can say, solid foundation. So they are all been playing different roles, and but as of now, after 10 years and after listing, I would say that we are heading towards becoming a truly listed and independently governed company.
Right. And management team has changed over period, or the senior management team remains
So senior
the same?
management team has been fairly has been the same actually. So there were 4 of us who were there from almost the beginning of the company. So I've been there from the beginning of the company. The three of our management team members have joined us over time in the initial years. So between 2010 and 2012, they are all with us. They have changed roles within the company, but they are still with us. And then over time, I mean, the philosophy was to kind of not have a very large team at the beginning and kind of build it up gradually as we grow, and that's what we did. So after completing about 4 or 5 years, then we brought in professionals from the industry. So another four members have joined us in the management team. 5 members have joined us in the management team from various organizations. So we have a 8-member, 8 or 9-member management team now, including myself. So it's a mix of, you can say, entrepreneurial blood plus people who are professionals from the industry. So 4 of us who were there from the beginning, we are more entrepreneurial in mindset. Whereas people who have come, in recent years are more structured and corporate in their mindset. So it's a very good balance that we have to truly run a truly independent company.
Great. And in terms of, you also have a great board, and I know there is Mr. Deepak Satwalekar, who I used to interact 25 years ago and learned a lot on housing
Yes.
finance. What does the board bring on table, and how active is the board?
So it is a board run company, because at the end of the day we don't have any family or any promoter behind the company. So it is a board run company. Even the other members in the board, the nominee members from the various private equity firms, are also stalwarts in the industry. So we have Maninder Juneja, who was an ED with ICICI Bank, and he's on our board. We have Divya Segal, who's ex-McKinsey, and he's also been an entrepreneur before joining True North. So he's on our board, and plus we have other members also who are nominee members, who are fairly active, and they are all veterans in their own field. Plus we have the independent directors. We have Mr. Satwalekar. So he has obviously carefully chosen which entities he wants to actually be on the board of. So it's, I mean, we must have done something either in our previous birth or in this birth to impress him to join our board. And he has been, he's been there for now almost 2 years. He's very, happy with the way we are progressing. And he basically runs the board. So, and we have 2 other directors who have been with us through the journey of the company. We have Sujata, she's an expert on credit, and Mr. Ghosh, who is from the you can say regulatory side or ex-regulatory side. So it's a very active board. It's a very active board, and yeah, practically all decisions are run through the board, and we that's how we run the company.
Sure. And okay, coming to the business part of it, so who is your peer group? What do you think, and who do you benchmark yourself with? It doesn't have to be a peer group that you're benchmarking, but who would you consider in this business really? Who are you competing with when you are giving a loan to someone? Who is that person also getting offers from, let's say, for example?
See, this business is actually very fragmented business. This
Right.
affordable housing business. So it's not like the let's say prime housing business. It's fairly different. And even we have been thinking, what business does it resemble? I mean, why is it so fragmented? Right. I mean, there is no business in India, business in the country, which is so fragmented in terms of market share. Any business you take, you'll have like top 3-4 players who have a large market share, and then you have a trickle of some local players, etc. But this is a very a strange and unique business where even the large lenders don't have a very large market share in this business. So I think it's because it's a one-time purchase. I mean, even prime housing is one-time purchase, but then it is fairly more templated. It's more standardized. People mostly buy large apartments in large cities, and they come from a certain background. They are able to provide their income documents, and that's how the loans are done. And it's easier for the banks to understand them. It's a more predictable evaluation model. In affordable housing, I think it's far more unpredictable in terms of both on the property side as well as on the customer side. So on the customer side, as we discussed, we have multiple combinations of income. So there are customers with some part of their income being formal, or one family member having a formal income. Other members don't have formal income. So it's truly a unique or one-time transaction. It's a very customized transaction, and which is why probably the larger lenders or banks are not able to templatize it. And because they're not able to templatize it, they're not able to enter the business, or they're not able to build a market share in the business. So this is, I think, a business which will where a player has to be consistent over a long period of time to build market share, and that will happen. So, for example, I mean, good examples that we have in this business are Group Finance, so where they kind of kept at it for a couple of decades, and then they started building market share in a couple of states. So for example, in Gujarat, everybody knows Group Finance, and they have like more than 15 or 20% market share in affordable housing. So and same for Canfin Homes, for example. I mean, in Karnataka, everybody knows Canfin Homes, and they probably have a majority market share in that state. So I think that is the secret to doing this business: being consistent in certain markets for a long period of time, and gradually building the market share through word of mouth is the way to do it. So aspirationally, those are the companies that we kind of associate ourselves with. We want to be like those companies, but with our own little twist or with our own little difference. But mostly we get compared to other, you can say more recent peers. So we get compared to Aavas, we get compared to Aadhar Housing Finance, we get compared to Aptus. But we are not very unlike them in terms of actual operation. It's just that they are also in affordable housing, and they have also started around the same time that we started. That is only common factor. Otherwise, they are not really our peers in that sense. And to answer your question as to whom do the customers get offers from? It depends. It depends on the segment of the customer. So if he's a customer who is a bank salaried customer, he could be getting offers from even HDFC or ICICI Bank. But if he's a truly informal customer, he may not be getting any offers. I mean, we may be the first one to reach him. I mean, that typically is what happens. So it is not like the customer is sitting with 3 offers, one from Aavas, one from Aptus, one from us. That never happens actually.
Right.
So it's about who reaches him first, who is able to give him a smoother experience, and then he's done with it, because he's doing this only once in his life.
Right.
So he's not really into the bargaining of let me try and get a better rate from XYZ, etc. So that's the characteristic of this business.
See, you mentioned that you are different from Aavas or Aptus. What is that difference?
So the difference is that one is that we are fairly focused on housing loans. 90% plus of our book is housing loans. So these are all customers who are building or buying their homes, right? So we are not providing loans for business or loan against property and things like that. I mean, we do give it to some customers who come to us, but it's not a core of our business. It's not a large part of our business. It's a very, very small part of our business compared to these entities, which are a very large part of their business is actually loan against property and business loans, right? So that is the primary difference. So which is why I said we are closer to Canfin or Group Finance, because they also, even after 20 or 30 years in the business, they still had about 85% plus of housing loans. 15% of course you can't avoid because of your sheer word of mouth and customer referrals, you get some loan against property cases which you will underwrite. But they have not gone after those segments, gone after those businesses, and that's the way we are also looking at our business. We want to be an expert on housing loans and affordable housing, and if some loan against property loans come, by the way, we will underwrite it, but it's not going to be something that we are chasing. So even in the long term, we are looking at 85% plus housing loans in terms of share of our business or product. So that is one primary difference to start with. Second is we consider ourselves to be a more national player compared to these entities. These entities their strategy has been to adopt a state and go very, very deep in that, and then come just adopt neighboring states and then go very deep. That's their strategy. Whereas we have taken a more wider approach. I mean, we have basically looked at the entire market. We said, these top 50, 60 towns is where affordable housing is there. And if we establish ourselves in these 50, 60 towns, let us do that first, and then we can expand into those specific states. I think it has worked well for us because we have got a better understanding of multiple states and what needs to be done in those states, etc. And at the end of the day, we have to do it at a lower cost, right? So we felt there's no point in spreading ourselves very thin in very, very small markets in states where the size of the market is also very small. So we have gone scientifically on this. Which are the large states where affordable housing is there, and let us take a large share of that. Of course, it's a slightly more, you can say, initially it's a difficult strategy because you are then competing with some of the larger players in the larger towns. So rather than if you go into the very small towns, then there is lesser competition. Whereas we have started with a larger town, so we faced the competition initially. We had to adopt certain methods, adopt certain, let's say, processes to overcome that competition. So we are very, very nimble in our process. We provide very quick turnarounds. And all of this actually came or got developed because we had to compete with the larger players. So if we had started the other way around, if we had gone to very small towns and started business, then we might have been a traditional company, where we are taking, a couple, 2, 3 weeks to process the loan. And the customer will be willing to wait because, it's a small town. He doesn't have too many options. And it's a housing loan. It's a one-time purchase. So people will be willing to wait. And so we would have never developed that muscle or that part of our company, which is providing loans very quickly, developing very nimble processes. So all of that developed as a reaction to or a response to competing with the larger players. So we said if we have to be in Ahmedabad, we have to be in Surat, if we have to be in, let's say Pune, and we still have to gain some market share, then we have to be much faster than your ICSE or HDFC or other players. So which is why we, that's how we have kind of developed that muscle or that aspect of our business, which is providing things fast, providing the process or doing the process very quickly, and that's become a competitive advantage. So now as we go into smaller markets, we are obviously much faster than, players who already are, are present there. So it's, you can say it's easier for us to gain market share, as we expand into smaller markets. And at the same time, yields are also not, or the spreads are not a challenge because, we are already operating at a certain spread by competing with the larger players. So as we move into smaller markets, we will be able to maintain the spreads because those are less competitive markets in a sense.
So one part, and that's the last question for me, I'll hand over to Sanket after that, which is like on the affordable side. I guess one of the issue that anybody would think is risk. That what is the risk and what is the kind of collateral, like what is even the collateral risk. But from what I understand, you say that you use a lot of data. You also have a decentralized or rather centralized. A centralized underwriting model. Now, this versus a fact that I know a state very well, like a Canfin says, I know Karnataka and I know the people very well, and hence I will just do that. Versus the model that you're saying is more spread out, but you are controlling risk through these models. If you can just talk a bit about that, like why do you think your processes are robust in using a centralized risk, and even the kind of data that you are using? If you can talk a bit about that, that'll be quite useful.
So so we have just tried to solve this question, which always comes up that if so let's flipping it to the other side. So for example, if let us say I was a traditional company, right? We were a traditional company, and we had to expand into new markets. Even in a particular state, if we had to expand into smaller markets, the question would come as to okay, so you are present in 10 towns in this state, and you are going to the 11th town. So are you capable of getting a good underwriter who can be in that 11th town and who can underwrite loans there? And you want to go into 40 or 50 more towns in that state. So are you going to get 40 good underwriters? Where are you going to get those underwriters from? How are you going to train them? And how can you train them so fast? Right? Because it's going to take time for them also to get trained. So this is a question that we anticipated long back, that and this is impossible to handle or impossible to address. You are never going to get an experienced underwriter in a small town in any state, because if he's an experienced underwriter, he would want to be in the large town, he would want to be in a large corporate, etc. So somewhere that argument is going to break down. So we said that the only way you can address this problem is to centralize underwriting. That's the way you will get expert underwriters. You will be able to put them in a larger place where they want to work. So then we had to address the question as to then how do we ensure that authentic information comes to us? Because if there is a local person collecting that information and passing it on to a centralized underwriter, then the question comes as to, oh, that may not be authentic. It may be whatever he has exaggerated, or he has his observation, etc. So we decided to address that problem. So how do we address this problem of keeping underwriting centralized, but at the same time getting the most authentic information from the ground, right? So that is where technology helped us. And see, if currently, I mean, if let's say, I don't think this business would have worked 15 years back, right? Because the technology did not exist for the kind of things that we are doing did not exist 15 years ago. So we could not have done this business at all. right? But technology, I mean, luckily or thankfully, the technology that exists today started 10 years ago when we started the business. And we have been kind of innovating and kind of moving ahead with that, which is how we have addressed this problem of how to get genuine information from the ground to the head office or to the centralized underwriting team. So as I mentioned before, so when the local person is going to meet the customer, he's practically recording everything, right? So he's recording where the customer is working, he's recording where he's living, he's scanning all the documents in original format. And all of this is getting uploaded on a real-time basis on a cloud-based platform. So today sitting here, I can quickly, even get into a video call with my relationship manager and tell him that, okay, you please take me around this whole factory and show me where this guy is working. Ask him to operate a lathe and show me. So I know that he knows how to operate a lathe. Because if he knows how to operate a lathe, I know that he will be getting at least 20,000 rupees a month, right? Because in 15 years ago, that was not possible, or 10 years ago, that was not possible. Then 10 years ago, you had to trust that local guy who was a relationship manager. He would put in a report, maybe on email saying that, I went to this factory, I saw this guy, he was working on a lathe. So how authentic that is, nobody knows, right? But today you can actually see a video of that guy operating a lathe, right? And that is how we have addressed this problem. So now nobody can question that, okay, whether this guy is a lathe operator or not, whether he has that skill set or not. And we know that if he has a skill set, he is earning some money, right? Nobody who is a lathe operator today in this country will be sitting idle, right? So that is how we are establishing that, and that is how technology has helped us. And we are, so it's more of a cultural thing in our organization. See, this is not a technology that is uniquely developed. We have not invented this technology. It's more about adopting the technology. So 10 years ago, actually, smartphones were not there. So at that time also we had this mindset of cracking this problem or addressing this problem. So when we started, actually, we used to give our relationship managers handheld scanners. So they used to carry handheld scanners to scan the documents in original format, right? So it was there only for a very short period, because after that smartphones came into place. So I think for 1 or 2 years we had to give these people these battery operated scanners. So they would go and swipe all the documents that they saw at the customer's place, and it all gets scanned up. So from day one we used to get all miscellaneous documents that the customer had in his house. So if he had LIC policies, we would get that. If he had any other investments, chit funds, everything, we would have access to all of that, which normally in a housing loan you would not get access to, right? So it's a cultural thing. So we are always obsessed with how do we make sure that the transactions are authentic. How do we find out whether the customer is authentic? So then smartphones came, so we were able to ask the relationship manager to record everything while he was traveling, etc. Then one more you can say change happened, which is that a lot of this data started going online. With the government also supporting it, a lot of provident fund data, GST data. So a lot of data is not available on customers online. You can actually access those databases and get access to that data. So for example, if you want to know if somebody is owning a particular vehicle, you can punch in the vehicle number and find out who is the owner, whether he's actually taken a loan against it, and so on. So now a lot of information is available, which is all can be digitally validated, and that's the next step in this whole process. So some data which is there, which is collected on the ground using these methods. Then we validate that data through these digital databases, and these digital databases are going to become stronger and stronger. So at some point, you may be able to get all information on a customer, whether he made a payment through Paytm, any such kind of information, right? Which will give you an idea about his credibility. So that's the next step. Then the third step is, about 4 years ago, machine learning became a thing, and we immediately adopted it. We had enough data on customers to run machine learning algorithms. So we immediately adopted. We are currently on version 3 of our algorithm. So that also predicts customers' behavior to a very good, in a very good way. So as and when new technology keeps coming, we just quickly adopt it. It is not that we are inventing it; we are just adopting it and seeing how it is relevant in our industry and applying it. So for example, mobile app came. Initially, everybody said, "नहीं, mobile app तो अपने customer के लिए it will नहीं चलेगा because he doesn't have smartphone. He's a very low middle class customer." But today, all of our customers have smartphones. And we are ourselves amazed by the usage. We have 70% of our customers using the mobile app. I mean, you may think that, okay, you've taken a housing loan, uske baad kya karna hai? Matlab, you just forget about it. No, the customer every month he wants to check how much is his balance. So they are using every month they are using the app. It is amazing. So customer behavior is also changing. So we are kind of going with the times in terms of what we need to provide to customers.
Sure, I think then that's very interesting. So I'll hand this to Sanket for more company level questions. Also, I request any participant has any questions, can you please type it in the chat box? So we'll ask that question. Thank you. Sanket.
Sure, sir. Yeah, sir. So my first observation is that Home First disclosures have been exemplary. You guys are setting a new standard as far as disclosures from an HFC is concerned. My follow-on question to Sanjeev sir's question that how you are different from the peers and what are the peers you really benchmark is that while you might be different on the kind of activities maybe they would be doing or the kind of activities they would be lending to. At the end of the day, what comes out of it is also important in terms of the key parameters or the financial numbers per se. So I'm sure you would be benchmarking yourself with a regular check with your peers also on certain parameters or maybe some of the key peers like maybe Avas or somebody else. So it would be good if you can highlight if how you where you stand in terms of certain important key parameters vis-a-vis your key peer maybe the one which you maybe benchmark. So yeah, some light on that would be helpful. And second, we still have scope for a credit rating. So that would be a follow-up. So where you stand in terms of talks with credit rating agencies right now with a debate which would include a comparison with your peers who would have higher credit rating. So yeah, those are the two fronts on which some light would help either from Nutan or from Manoj sir. Yeah.
Sure. Let me start and probably Nutan can add. So we are, we are benchmarking ourselves, and like I said, although you can say aspirationally we are looking at two other peers. We have to also, we have to also benchmark ourselves against our own contemporaries. So in that sense, we benchmark ourselves against entities like Aadhar, Avas, etc. On one side, and we also benchmark ourselves against Canfin and Group Finance, etc. on the other side. And so some of the you can say metrics that we look at are basically the productivity of our relationship managers. So what is the disbursal per relationship manager or disbursal per salesperson, disbursal per branch? What is the AUM per branch? So these are things where we think we are on a journey to catch up with entities like say a Canfin or a Group. So we are higher than our contemporary peers on those metrics. But of course, all of that will make sense only if it is all translating to something for the shareholder, which is say a lower cost. So basically a cost to income or a better ROE or you can say better spreads and so on. So those are the other metrics that we look at, and we feel that we are doing you can say doing very well compared to our even contemporary peers. So if you look at our cost to income, we are you can say at a comparable cost to income to entities which are twice or thrice our scale. And which is our thesis, right? I mean, we are basically saying that we are using technology, but technology is not all for, it's not entirely for customer experience. Yes, customer experience also will help us in the long run because customers will refer other customers, etc. But then it is also helping us with the cost. So we are able to operate at a lower cost. Our cost to income is in the same range as entities which are double or triple our AUM at this point of time. And our aspiration is really to catch up with the larger entities that we spoke about in the next maybe 3 to 5 years. So so we are doing well on these comparable metrics. Maybe Nutan can give you some more specifics on some of the metrics which I talked about. I just mentioned it in a very qualitative sense.
Sure. So rightly mentioned, the comparison at a company level, whether with the contemporary peers or with the more established peers, is very fairly detailed. So productivity is one of the matrices, and that gets discussed at a management team level because the operations, etc., get driven by it. We also compare technology on peer by peer basis as to how where are they ahead of us. There are some aspects where we can learn from them, and we also try and keep the gap in terms of how ahead we are, because the peers are also catching up. So that's the other aspect that we benchmark on a fairly detailed basis. Of course, things like borrowing detailed benchmarking is done to see if there are aspects where we need to focus on. For example, one of our analysis called out that we were missing out on a couple of public sector banks. And then we worked on them and then we converted them. It was just a miss on our side. With that, I think I'll come to the second question, Sanket, on credit ratings. So credit rating agencies, it's, I think, amongst the top three agenda items for the company at this stage. So we're very focused on this. We have been engaging with the rating agencies on a fairly detailed and a regular basis. If you look at rating agencies, the items they look at, and we also discuss with them benchmark again with both types of peers. So for example, number one, they look at asset quality. And they have been fairly comfortable with asset quality, and given the operating environment and the way things have panned out for rating agencies, we ended up having every quarterly discussions with all the three rating agencies that we have engaged with through the COVID cycle. If you look at end of June numbers, our numbers were ahead of our contemporary peers as well. The fact that our disclosures are good, we're giving all bucket movements. We are not doing anything. For example, we are not repossessing assets on a balance sheet. We are not doing any ECGLS. So the disclosures are clean, and in one place, kind of gives them a lot of comfort. If you add up the numbers, our numbers are any which ways better than contemporary peers as well. Number two that they focus on is liquidity, where we've been fairly strong, and that's kind of captured in the rating rationales if you see. The third point, which we've been discussing with rating agencies, is the geographical concentration or otherwise. So they are not very comfortable with the geographical concentration, and they've called out the fact that we are amongst the most diversified players in the affordable housing finance space, aside from Aadhaar. So after Aadhaar, we will be the next best diversified player. Things like leverage capital, I think everyone is well capitalized, so that point gets covered very well. I don't think there is any winner or loser there because everyone is at par on capital. Then the last 2 points which get talked about is scale and profitability. Profitability, I think, has been hit for most players in the last couple of years because of the high liquidity everyone has had to carry. So almost 1.5 to 2.5% impact on the ROE is just coming from the higher liquidity that any one of us is carrying. And rating agencies recognize that is the need of the hour. So all in all, when you put everything together, the comfort is very high. And then you ask them the eventual question, so when am I getting that upgrade? And then it comes down to the environment, which I don't think any one of us has any control. So then, whether there is another round of COVID, whether the wave 2 has really passed, and those conversations, we are not the real experts. So it gets down to that. And one more thing, which is the size conversation. So, for example, the conversation that ends up happening is that Aavas, for example, one of our closest peers, they got the rating upgrade despite ticking all the boxes at a certain size. Let's wait for getting closer to that size. So that's where it is. Aside from that, we have not heard anything which rating agencies are not comfortable with across all three of them. So we are rated by 3 rating agencies, 2 on the long term and 2 on the short term. So that's a very consistent feedback that we have been hearing. Sorry for the very long answer.
No, thanks. One thing from your explanation was about capital. Now, one thing that I wonder that all the recent affordable housing companies have a pretty large piece of say capital adequacy. First, if you can throw some light, why is it so in case of all the companies? Despite that, it impacts return ratios also. And also that we are very low on leverage as of now. Where do you see our leverage, suppose in FY 24-25? We don't need any fresh capital as of now. I would assume that maybe for next 3-4 years also, there won't be any next round of capital, or is it so? You can highlight also that. And one more thing, since we are talking about the liability side, that NHB borrowing, which we have a privilege access to, or maybe all the affordable housings companies have a privilege access to those debt pool. Do we have a potential to increase that increase that as a share of total borrowing from here on?
Sure. Maybe I can just get started. See, leverage is a function of growth and how fast we're looking at. Going back first and to your first part of the question, why so much capital? So if you go back pre-ILFS, we were operating at a leverage of 5 times or close to 5 times and very comfortable with it. But after ILFS, the operating environment of what leverage means and what comfortable leverage means for rating agencies and banks have changed. And COVID hasn't helped that situation. So we were getting comfortable, everyone was getting comfortable by March 20, and everyone was saying, okay, let's now start scaling down the liquidity first, the cash that you have on the balance sheet first, and then the leverage question comes second. But COVID hasn't helped that. COVID came in last FY21 first quarter. I think everyone across the board, the most sane thing to do was to do collections and was to get as much liquidity on your balance sheet as one could. And that's been the situation for some time, and it's only started to getting slightly better as we speak. So that is, so when the ILFS situation happened, the most comfortable thing to do was to raise capital. We had the advantage at that time of having shareholders who didn't skip an eyelid on saying, okay, you need capital, here it is, just go ahead. When we were doing the COVID situation, like Manoj mentioned, the whole Warburg transaction, they were more than happy to provide us more capital, and we said we feel that about 75 odd crores is what we need at this point of time, and if we need more later we will come back. Luckily we haven't had the need, because we any which ways did a public issue and we also raised some capital there. The purpose of the capital raise at the public issue was essentially to let the business focus on growth and operations, and then not come back to the market over the next 4-5 years. And we can just put our head together and focus on everyday operations, running the business. And you rightly said we do not foresee the need of capital at least for the next 4 to 5 years. We are projecting a growth of around 30% for the first 2 years, this year and next year, and then around 25% for the following 3 years. So when you do that model and you project an average ROE of 15% over the next 3-5 year period, we are sufficiently geared on capital as and leverage. Coming to the question on NHB, we are already an outlier in terms of the percentage share that we have from NHB. So we were at around 30% in March 21. And we feel that that is a very high share. And as we diversify our borrowings to mutual fund NCDs as well as to some other lines of liabilities, that share logically will start to come down, but we are comfortable to hold it at around 25% on a more medium-term basis, which will also be at par or better than most of our peers. So 25% is something we feel more comfortable with. 30 is an outlier, is what I would say.
Sure.
Okay,
That was.
there are a few questions maybe on the chat. Maybe I can ask that.
Sure.
So actually, on leverage, what is the leverage ratio you are comfortable with? Let's say in 3-4 years, like what is that comfort level? Where again you say that I need to raise capital.
So today we are comfortable if our business as it is was at 5x, and that's what rating agencies are also comfortable with, and that is on a gearing, so debt to equity. So leverage makes it 6 times. 3 years down the line, 4 years down the line, if COVID situation is behind us, which hopefully it should be, and we are not looking at any black swan events, then 6-7 times should not be a problem, is what we feel.
Sure. Okay. The next question: in this environment of data mining, we have so much data. So, any way of earning fee income by cross-selling other products?
So possibilities could be there, but then compared to a housing loan, other products, typically the ticket sizes would be small. So just in terms of the book size, it would be fairly small, in terms of size. But yes, there could be some opportunities to, and we are working on those opportunities, trying to understand the customer a little better, what are their requirements, etc., and to see if we can provide a very seamless experience for the customer to take some of those loans. Existing customers, we're not talking about new customers over here. So if an existing customer probably wants to purchase something which is a consumable, etc., whether we can provide him a loan. So this is something that we are exploring, but it's not likely to be a very large book. Maybe I can't visualize right now, but maybe not more than 5% of the AUM.
Sure. At what level of our asset book you expect to hit a saturation of affordable housing, and you'll have to look at prime lending to sustain business growth?
See, we are basically, I mean, at least our theory is that this is a very large business for several decades. And so we are not visualizing a scenario where we are going out of affordable housing and doing prime lending. And these are two different businesses because of those reasons which I mentioned. I mean, prime lending is a templatized business where it's a very predictable outcome in terms of whether the person gets a loan or not. Affordable housing is a more customized business where both on the property side as well as on the customer side, it requires there are some nuances in underwriting. So very different businesses. I think mixing them will only get either party in trouble.
Right. Okay. What is the incremental cost of borrowing?
So ex-NHB, our incremental cost is around 7.5 to 7.6.
Sure. Any policy that you can talk about on here from your liability side in terms of how you want to kind of do it? You want to, how sustainable, like is a question of sustainable versus cost of, funds. So where are you in that spectrum, and how, if you can just talk a bit about that?
Sure. So maybe I can get started, Sanjeev. So Sanjeev, I think from a liability perspective, if you see what is most critical, and then you go to the next topic. To start with, I think the number one item on our strategy is ALM. So to have ALM, positive ALM across all time buckets, that is the number one thought process that should be there at all times. That makes essentially to have longer tenor loans, the more 6-7 year tenor loans, and that is also the whole purpose behind this whole NHP whole assignment, because they end up being 7-year plus loans. If you look at the behavioral tenor of our asset, that's also 7 years, so it kind of matches off very well, and that's been the focus that we've had, and that's one of the mandates from the board as well. The second item of liabilities is diversification. We have all private sector banks, large private sector banks that do lending to NBFCs. We have most PSU banks. So in the large PSU banks, with the exception of a couple of them, we have relationships and deep ones with all of them. We operate on a consortium structure just so that we're transparent with all our banks, all our lenders, and the terms are consistent with all of them. It is a difficult one, but that's how the design is, to operate at a consortium structure. Diversification also, we will see with NCDs going ahead, moving ahead, say from now on to next year, you will see a lot of that coming up. We are also working on raising funds from DFIs to do some rupee bonds. All of that will also start, catching up on the diversification. The third item, which is important from a liability strategy perspective, is liquidity. So how much liquidity should we keep on the balance sheet in terms of cash, and how we manage that liquidity also is very well governed by the board. So how much of that can be in fixed deposits, how much that can be in liquid funds, which liquid funds. So all of that is a very ongoing conversation. Finally, of course, cost is also an important aspect, but definitely in our scheme of things, it comes below all of the first three that I mentioned. So cost is obviously a discussion point. So whenever there is any term loan from any bank or assignment transaction, we benchmark it to what the incremental borrowing is for ourselves with other banks as well as our peers, and so that's how we are operating. So that's how we are looking at the whole liability structure. Manoj, if you want to add something.
I know. I just wanted to add that above all else, we follow prudence and conservatism on liability side. Above all else, so no, absolutely no fixed rate loans, absolutely no short-term borrowing, and we allow very easy prepayments for customers so that that liquidity is always there. And in fact, that was one of the huge, you can say positive points in the early days of the pandemic. So when last year first quarter, when people were really challenged, we had, even at that time, we had fairly good prepayments, which kept us liquid, and the prepayments plus our regular payments was more than sufficient to is always more than sufficient to pay back our lenders. So very conservative approach as far as the asset and liability management is concerned.
Okay. Few more questions. How large can the loan book become before you start overlapping with banks and larger HFCs?
I think you asked that, Sanjeev.
Yeah, I think it's a slightly differently worded question, but yeah.
Same type. Yeah.
Right, yeah. So I think there will always be some overlap. We already also overlap with some banks because we end up, getting some formal customers, in our business as well. So there will always be overlap. So, but I don't think there should be, like I said, this business is very, very large, and just in terms of quantum, it is about 50% of the loans in the country. I mean, in terms of number of loans, in terms of numbers, so it's about 50% of the loans in the country. In terms of value, it will be more like 20% or 25%. So it's a business that is there to stay for several decades. So I don't think we are ever going to get into the territory of the banks. Yes, there will be some overlap in terms of customers, etc. That is a day-to-day thing, but we are not really going to go after prime loans, in the foreseeable future.
Right. Okay, I'm just reading the question verbatim. What are your thoughts on account aggregator framework and what could it do for your business? I guess.
Yeah, so account aggregator framework is something that we are very, very excited about, very happy, that it is happening. Because we have been, like I said, for about four years back, we started this journey of actually aggregating the accounts ourselves. So which is basically all the digital footprints of the customers. So wherever the customer has a digital footprint, so whether if he has bank statements, if he has GST records, income tax returns, etc., we have been aggregating it ourselves through various service providers. So whenever we get an application, we look at what are the digital footprints the customer has, and we compile all of it to arrive at you can say judgment on the customer's repayment capacity and ability, etc. With account aggregator network catching up, that job will become easier. So we can just, for example, request that account aggregator with particular ID of the customer, and we will, just like we are hitting the bureau now. So we should be able to get all the accounts of the customer, all the digital footprints of the customer in one place. So it will make our life easier. We are compiling it from multiple places now. We will get it in one single place. And by the time, this really becomes mature, this business, this account aggregator network becomes mature, we will be in a better position to understand, how to put together all of this information, which is available digitally on a customer. Because we are doing it manually now. So we'll be in a far better shape to kind of, interpret that information that is available, and we'll be able to provide far faster turnarounds to our customers.
Sure. Okay, similar question from other side, which is when people lend to us, is there a leverage ratio they ask for?
In some of the term loan sanctions, it is there, but it is very high. It is not some, like, for example, 8x or some stuff like that. So it's not something that bothers us.
Okay. How much of credit assessment is solely app-based and how much is independent on the ground?
No, so we don't do anything. I mean, at the moment we are not underwriting purely through the. You're talking about acquisition or the underwriting? Sorry, missed that.
I guess I'm just reading the question as is. So I guess it's more about underwriting, I think, because it's credit assessment.
Yeah. Okay. So underwriting, we don't. I mean, there is no. I mean, without a human looking at the loan, we are not underwriting currently. We are only providing the underwriters with a score. So there is an algorithm which provides a score to the underwriter that helps the underwriter to prioritize. So if the score is very good and the probability of default is low, then they spend less time on evaluating the loan, and it also gives them a kind of guardrail when they underwrite the loan. So if they know that at least they are not far off the mark, with their decision. So all of it is manual at this point of time, or underwritten by the underwriter. But we are providing. So for at least 50 to 60% of the loans, there is a probability of default, which is fairly accurate in terms of the final decision.
Yeah. What is the demand momentum we are currently witnessing?
Demand momentum is phenomenal. Actually, it's much higher than what we have seen in the recent past. I mean, like in the last 2 years. So even pre-COVID, it's pre-COVID. At least for 6 months prior to COVID, we didn't see this kind of momentum in demand.
Wow. What is the reason for asset quality weaker than Awas and Aptus, despite having a larger salaried mix?
Asset quality, I would say, is on par, with these entities that are being mentioned. So if you see last quarter, we reported 1.9% GNPA with only 60 basis points of restructuring, right? And we did not do any loans under this ECGLS program. So all added together, it was 1.9 plus 0.6, 2.5%, which I would say was very was comparable or even better than these names which are being mentioned. Plus, if you look at all our leading indicators, which we also publish, the bounce rates, the 1 plus, 30 plus, etc., they are, I think, comparable with the peers.
Right. The question is that home loan rates are continuously dropping and there's a margin pressure on the prime guys. Do you expect prime guys to enter your segment and possible headwinds to our margin as well?
No, we don't expect that. Yes, there is competition in the prime segment is probably going to keep on intensifying, because that is a segment that is easier to underwrite. It is more, as I mentioned, more structured and templatized and easier to understand and underwrite. So there will be more competition in that segment. But our segment is, it has a totally different nuances. The underwriting has to be, there is a lot of observation based or assessment based underwriting. And you have to, put together all the things that I mentioned, which is, you have to look at the digital footprints, other data of the customer. So there is a lot of triangulation that has to be done in our business to underwrite the customer. And underwriting, I would attach about 30 to 40% weightage. 60% weightage is collections. So ours is basically a business where customers have all the good intentions. They have the ability to pay at the time of taking the loan. But these are, at the end of the day, lower middle class customers, and they are vulnerable to various fluctuations in their life. So at that time, we need to be very quick to, you can say, provide them the help that is required, or intervention or counseling that is required to keep them going. Otherwise, they may get into more debt. They may end up, having problems with repayment, etc. So I would say collection is 60% of the business, and which is why this is not something that larger lenders can easily get into. Because even if they develop the assessment expertise, the collection expertise is not something that will be easy to develop.
I guess those are all the questions. Sanket, you have any last questions? Then otherwise we can wrap. I guess you have already run quite ahead of time, so yeah.
Yeah, sure, sir. There was just a couple of things from the last few questions only. So we already have a very low, very short turnaround time of 2 days. So is there a scope to maybe even reduce from there with the help of account aggregators? And the one of the key things which you disclose is the bounce rate. This is the flip side of maybe more disclosures, you get more questions out of it. So I just wanted to know the normal situation flow through, maybe from bounce rates to actual GNPA. What would it be? Those were the last questions.
Yeah, sure. So you see, not prior to pandemic, we used to be at about 10% bounce rate, and then our one plus used to be about say 30% of that, 30 to 40% of that, and then half of that used to be the 30 plus. So around 2% was the 30 plus, and then half of that used to be the 90 plus, about one or less than one. So it is let's say if you start with 100, we are talking about 40, which is which is overdue. Then half of that, about 20, which will be sorry, 4 out of 100, which is overdue. Then half of that, which is 2, which is 30 plus, and then half of that, which is 1%, which is the GNPA. Currently, also, I mean, the ratios seem to be the same. But the numbers are higher. So we are at about 17%, 16-17% bounce rate, and our one plus is about half of that currently. So about 8.5 or 8%, you can say, and our 30 plus is at about 5%, and we are at about half of that, around 2% in terms of GNPA. So I think it will take about 6 to 9 months for all the ratios to kind of inch back to earlier levels. So as the bounce rates keep moving back to 10% or 10-12%, I think all the ratios will flow back to the pre-pandemic levels. And the reason for us to give all these disclosures is that we just want to make people comfortable with how the business is, with all the metrics in the business. I mean, if they understand the business as well as we do, they will be more comfortable with it. So, which is the reason we are providing these disclosures.
So, and the other question on turnaround time, maybe we are already at 2 days with all the help that we may get from account aggregators. With the help of account aggregators, is there a scope to maybe further lower it down?
Yeah, so
that's
so there are two aspects to it. One is the turnaround that we are providing, which is the you can say approval for the loan, and then the disbursal which happens after further checks on and the customer has to also submit his property documents and so on and so forth. So I think there will be improvement on both. With account aggregators coming in, yes, this 48 hours also can be crunched even lower. So we can actually move to a situation where we are practically providing instantaneous approvals. If all data is available on the customer, and we should be able to provide much faster turnarounds. What will also improve is the disbursal turnaround times, because a lot of the property related data is also getting digitized. And I think today itself there was some announcement that in Maharashtra they are going to do e-registrations of properties. So as more and more properties get registered online, and that data is also available online to us, then it will be even far easier for us to provide provide the loans. Because now today in many of the states you have to go to the sub-registrar's office to check the records to see if the property really belongs to the customer and so on. As that also starts getting digitized, we can provide even faster disbursal turnarounds. So yes, yeah, that's on the cards, and that's something which is which will keep on improving.
Sure, sir. I think that sums up the session, and
Great.
I'll hand over to Sanju sir for closing remarks.
Thanks a lot, Manoj. Thanks a lot, Nutan, for taking.
Thank you. It's a pleasure.
Yeah, and I wishing you guys all the best for an exciting journey.
Thank you.
Thank you so much. Thank you so much.
Thank you, Sanket, for putting everything together. Thanks a lot.
Thank you, everyone, for participating. Thank you.